worse, and those are the reactions on the screen. We've got Dayanand Mittal, oil and gas research analyst at JM Financial, now joining in. Dayanand, great to have you with us. So we've got a broad construct which our colleague Sudarshan has just laid out, but you tell us, let's start with the positive news. In the entire oil and gas space, where could we see pleasant surprises? Which are the stocks that you would be relatively more optimistic on?
So from a quarter perspective, OMC's earnings is where we will see positive surprise after 2 quarters of 2 challenging quarters. But I think key focus from market perspective would be around current uptrend in oil price, where it stabilizes, particularly with Trump coming in from 20th, there will be more clarity on what policies he will actually implement versus what he has been saying. And second would be on first Feb budget. 2 key takeaways that market would be focusing on would be whether and how much would be the compensation for OMC's LPG losses. Given the losses, it will be in the range of 35 to 40,000 crore in FY25, while the budgetary provision is around 11,900 crores. And if there's no hike in LPG price, let's suppose Delhi election, then the 35-40,000 crore run rate will continue even next year. So that would be one key event market would be waiting for. Second, though with rising crude, this expectation would now get muted, but any chance of any hike in excise duty on petrol, diesel, that would be the second thing that market would be waiting for OMCs. So quarter might be good, but outlook wise, we remain cautious on OMCs. We prefer ONGC All India over OMCs, primarily because of our view that the crude price is likely to be supported around 70-75, driven by OPEC's a reasonably decent pricing power.
Okay. Fair point. We need to watch out for the way oil moves, because then these things could change very quickly in Q4 if oil prices continue their upward trajectory. On city gas distributors, then that's the question, because the derating happened when we got to know that they'll get lesser APM gas, but since then all the companies have made announcements and it's not as bad, but now they're getting a slightly better share. Where are you on the city gas distributors, and what is the earnings hit that you are right now penciling in for not just Q3 but even Q4?
So the challenge there is more structural. Yes, this shocker came a bit was a negative surprise. So what would we have seen in terms of decline in APM allocation over 2 years, probably next 2 years? That happened in a matter of 2 months. So yeah, there was some reversal to it, but that's only about 20% of the cut that government had announced. So it's only a marginal relief. Our key reason for a negative view on IGL, MGL, and the CNG dominated CGD companies is APM allocation, APM production by ONGC All India is on a declining trend. Government is gradually moving APM to new well gas, which will be priced at around $9. So gradually, CGD companies' APM allocation has to come down by about 7-8%, 10% every year, which would mean they need to hike CNG prices by 2-3 rupees per kg, which will gradually erode the differential or the competitiveness of CNG versus petrol, diesel. So structurally, we continue to remain negative on IGL, MGL. Yeah, this relief came as an incremental positive, but the structural challenges prevent us from taking a constructive view here. We rather prefer Gujarat Gas, which is more driven by industrial segment, and where our thought is spot LNG prices in the medium to long term should moderate with a lot of LNG supply capacity coming in globally, and this should help Gujarat Gas to restore its competitiveness versus propane in the medium to long term.
Okay, got it. So there are concerns there as well, and longer term concerns. That's an interesting point. You tell us that overall, production is on the decline from ONGC and Oil India itself. So I mean, how much APM gas would be available anyway to allocate to these companies? Got that. Let's talk Reliance now. And again, I'm trying to pick on the silver lining here, because the expectation is that refining margins have picked up. Yeah. Is that sustainable? What are you expecting for Reliance's oil and gas business?
Yeah, so Reliance Oil and Gas business, we expect the O2C EBITDA to be up about 10-11% QOQ, as you said, rightly because of uptrend in GRMs. GRMs for Reliance, we expect around $8.4 versus around $7.1 QOQ. GRMs have been weak in last 2 quarters, 1Q, 2Q, recovered in 3Q, but again starting to look a bit subdued in the current quarter till date. This is despite the winter in the western part of the globe being quite harsh this time, and hence which is supporting heating oil demand. So it's a bit surprising that GRM has started to weaken again, but our sense is GRM should be reasonably in a decent shape of around $6 per barrel. Singapore GRM for Reliance around $9.5, $10. Given the demand growth is likely to still outpace the capacity addition, because most private refiners globally are not setting up refining capacity given the threat of EV or in terms of petrol diesel demand on the long term. So refining margin outlook should be quite reasonable, at least in the next 2-3 years.
All right. Thank you very much for joining us with that perspective. Appreciate it very much here on CNBC TV18. That's oil and gas expectations as far as the third quarter is concerned. Markets have pulled back a little bit. You know, we're down 185 points, 23,250 is where we are at.